My name is Peter Mauthe, and I'm here to present to you today Trademark Capital Management's view of the September 2024 Federal Reserve Open Market Committee meeting. In summary, for the Federal Reserve meeting yesterday, or at least the summary is given by Chairman Powell, the GDP economic growth is slowing but constructively positive and steady. The core PCE inflation, which is what the Federal Reserve watches most closely, is higher than target, but it's heading in the right direction. Unemployment, however, according to the Fed anyway, is now the primary concern of the Fed. And it's for that reason primarily that they cut interest rates 0.5%. The chairman made it clear that this should not be construed to be the path that they're on, meaning when they cut rates in the future, the 50 basis point or 0.5% cut in rates at this meeting will not set a standard for future reductions. They also made a point of stating that the quantitative tightening or the balance sheet reduction is to continue with no changes. Now, the expectations set by the Fed are that there will be two more 0.25% rate cuts this year, with four more 0.25% rate cuts in 2025, taking the Fed funds rate to 3.25% to 3.5% by year end next year, 2025. Now, if we take a look at this chart, which we've taken a look at after each of the Fed meetings, the green line represents the 2-year Treasury note yield. This yield is set by the open market. This is not set by the Federal Reserve. The Federal Reserve does control the Fed funds target rate, which is the black line, which until yesterday, on the right-hand side of your screen, until yesterday had been at 5.25% to 5.5%. After yesterday's reduction, it's now at 4.75% to 5%. Now you can see that the 2-year Treasury note yield has been way below the Fed funds target rate as set by the Fed. This is not an unusual occurrence. This just means that the Fed tends to be behind what we call the curve. And so the 2-year Treasury note is still anticipating a good bit of reduction yet to come. Now, another item I'd like to point out is the yellow shaded zone, which is between 2% and 3%. This is the ultimate end to the Fed funds reduction that we're likely to see sometime in 2026. Now, we're not likely to see the 0% interest rates that we saw for so many years following the financial crisis, simply because we're not going to be in such a crisis state. Or maybe I should phrase that a little bit differently. We're not likely to see 0% interest rates again unless we have a true global financial crisis. So this 2 to 3% zone is important because if that's where the Fed funds target rate goes, then what we can expect of the yield curve is something like this. Now, the black line represents what we call the typical yield curve, going from 1-month interest rates on the left all the way to 30-year interest rates on the right. Now, the inverted yield curve, which means typically we'll have a yield curve as illustrated by the green dashed line, which short-term interest rates are low and long-term interest rates are high. We haven't seen that for a long time. So a year ago, the yield curve was inverted, meaning short-term interest rates were higher than long-term, and the blue line represents what they were yesterday. Now, the yield curve is still inverted, but as what we can see in the future, based on what the Fed has told us, that if interest rates on the short-term end, Fed funds rate end, go to between 2 and 3%, we can see longer-term interest rates in that 3.5% to 4.5% range. And so the yield curve will look something like what I've illustrated here in the green line. Now, the interesting point and the important part for investors is that the biggest change in interest rates is going to come in that short-term range from 0 to about 1 year. We can expect substantial declines in interest rates over the next 2 years in those maturities. But in the longer term end, in the mortgage rate end, by the way, interest rates aren't likely to come down more than 1% further. Now let's summarize all of this into what it means for investors. We can expect much lower interest rates on money market funds and savings accounts. We can expect modestly lower interest rates coming from our bond portfolios, and we can expect modestly lower mortgage rates in the future. And simply because these rates have already anticipated much of the Federal Reserve's future target moves in interest rates. As a result of this lowering interest rate economy or an interest rate policy by the Fed, we can expect a potential for a stronger economy. Now, historically, this decline in interest rates, this start of a decline in interest rates by the Fed, has not been a good sign for the stock market. But longer term, the economy should be in a better shape to resist a recession than it would otherwise be if the Fed was still holding interest rates higher. Lastly, we can expect the US dollar to become weaker, which simply means foreign goods that we've been purchasing and will purchase in the future will remain at present prices, which are attractive in relative terms since the dollar's been really strong, but their prices are likely to go up since the dollar value will be going down. That will also, by the way, trickle down into inflation for us in the years to come. That's it in summary. You can follow us at trademarkcapital.com. You can follow us on Twitter, which is now X. You can follow us on YouTube as well as LinkedIn. If you have any requests for future videos on our behalf, we'd be glad to make those for you. Just let us know the topic that you'd like us to cover. Thanks for viewing.